All right. Well, good evening, everyone. Welcome to our second presentation of Financial Basic. Again, my name is Martin Corrett. I am a financial counselor with SISIP. And today we get to talk about credit and debt management. So we're going to talk about credit itself, understand credit a little bit more, and we're going to talk about ways to help pay down debt and really get a good understanding of all the debt information. Some of the benefits of this is to take control of your financial future, help you achieve your life goals, provide for yourself and your family. Again, being a smarter consumer and hopefully help reduce stress. So again, financial stress is a big one. If some of you have not seen our first presentation about budgeting, really that's the step one. So I certainly encourage you to go back to have a look at that presentation because it's really is the first step and core before all of this. So credit and debt management. So credit is certainly something that is used for a lot of things in this day and age. It's almost impossible in this day to not have credit at some point in our life. So it's important to understand it and work with it properly. I have absolutely nothing against credit. It can be a very useful tool, absolutely. But it's also understanding that it can also be a dangerous tool where a lot of times a lot of us get ourselves into trouble. Never on purpose, but it happens. So ways to try to avoid that. So a quick, did you know federal regulations say that credit card companies have to ask your permission to raise your credit limit. So that came into action about 15 years ago now, maybe a little bit longer than that, where previously, if some of you have had credit for quite a while, we used to get a little notice that says, congratulations, we've increased your line of credit. You know, they made it sound real good, just saying we're so good that they've increased it. The issue with that is they kept increasing people's limit, which people got into more debt for that same reason. So now they need to ask our permission, which is always a good place to remind you that when creditors offer to increase your line of credit, you absolutely have the right to say no. So if your line of credit meets your needs, you don't see a need to have more, again, it is absolutely okay to say no. The same way that it's okay to call your credit company and ask them to reduce the available credit you have on your products if you don't feel that you need that much. It's protection for yourself. And again, when we don't need that much out there, having big available lines of credit does not necessarily help your credit either. So in 2017, average household debt for Canadians. If you guys want to use the chat, we've got 26,000, 56,000, or 158,000. So total household debt. A, B, or C.
And Martin, we're not counting mortgages in this, I assume.
I'll be honest, in this number, it does include mortgages. So I think that'll kind of give it away at that point.
Sorry.
No, that's okay.
I'm too competitive. I want to get the answer right.
So therefore, yes, I'm seeing the answers now. So that's correct, 158,000. So that did include mortgages. If we look at just credit card debt alone, the last quarterly report I saw for Canadian credit card debt, the average is that the average Canadian currently owes $1.84 on credit for every dollar earned. So again, that's almost double, the earn rate. So there's a very big dependency on credit for a lot of people, which comes at a very high cost. Now, we're expecting to see some of these numbers come down a little bit because, again, with the impact of COVID, there's been some shift in the spending. So it'll be interesting to see what happens. But as the last report, which was late 2019, was $1.84 for every dollar earned. So not a good thing. Paying your credit card bill just a couple of days after the due date won't affect your credit report. True or false? False. Yeah, you're correct. So that's false. So late is late. And I can tell you that I have worked in the banking industry many years ago. I started as a customer service representative, and these are the type of calls you'd get on a very regular basis. Well, it's just a day late. Like, fortunately, late is late. So it is important usually to make those payments at least a day or two before the actual due date, again, just to ensure that the financial institution receives the payment on time to avoid any late payment charges. All credit cards have the same grace period, also known as interest-free period. True or false? False. False. So yeah, you're all right. All right, we got a good group today. So yes, it is false. Depending on the bank and the product, minimum grace period is 21 days. Some will go up to 26. So again, this is where we talk about a little piece of paper that we all get anytime we get a credit product called terms and condition, which is, typically 6-point font writing, so very small with a ton of information and legal jargon that a lot of it we don't understand, but it's still very important to look at it because this is the type of information that is on there. So our grace period, interest rate, penalties if we miss payments is part of that terms and condition. So it is very important to read, to simply understand the product that you have so you can then play within the rules. Because unfortunately saying, I don't know, doesn't work with the bank. Like, well, you should have known because it's in your terms and condition. So I admit it's very boring to read, but it is important to read. Last month, your credit card balance was 0. This month, your statement shows that you made a $500 purchase. If you pay off $400 by the due date, you will be charged interest only on the $100 left to pay. True or false? Oh, here. This one catches people on occasion. So looks like we got some false from most people here. Yeah, you're all correct. So it is false. And the reason for that is it used to be true many, many years ago. It used to be true. Now banks use what they call the average daily balance calculation. So in this example, depending on when you made that purchase and when that payment went in, what the bank does is they will average the amount that you've borrowed and then charge you interest on that average. So it's a way for banks to charge more interest. But the benefit about knowing this is also works the other way. So if you are carrying a balance on a credit card and you're slowly, you're paying it down, so you're not paying in full, most of us have been taught that when you get your credit card bill, you pay it by the due date, last day possible or the day before. Well, if you're trying to pay down because of this method, if you actually make your payment earlier, so as soon as you get the bill, that will reduce a little bit your average balance for the month, therefore save you a little bit on interest. Same way that if you, let's say, make $100 a month payment, well, even if you did $50 and then 2 weeks later another 50 within, before your due date, both payments, again, you're helping reduce your average daily balance, which in turn helps you save a little bit on interest. So little trick that they don't talk about when it comes to that. I think we have a question.
Yes, it's Igor here. Is there anything wrong with putting money onto your card every time you make a purchase? Does that affect your credit score or anything in the background?
Very good question. And that's an area that people sometimes make a mistake, especially if you're trying to build credit. So what I'm understanding the question to be is if you make a purchase and you pay it off right away, in other words, or put money on your credit card. So when you make purchases, there's really no balance. So the problem with that is if you pay for all your purchases before the statement is actually generated and sent to you, then your account balance is always 0. So it's as if you're not using credit, because every time, they call it cycling, every time it cycles, that statement gets generated, it's a 0 balance. So it's almost as if you're not using it. So if you're trying to build credit, you're better off doing your purchases, wait for the statement to be generated, and then paid in full. That absolutely, no interest and is good for your credit. Otherwise, it's like you're not building anything because it's not considered as if there was activity on that statement. So I hope that answers that question.
It does, thank you.
Perfect. If you use your credit card to take money out as a cash advance, you don't have to pay interest on the amount you've withdrawn as long as you pay for your credit card bill in full by the due date. True or false? So we got so on that one, so cash advances again is daily interest. So the answer is false. Anytime you use a credit card to take a cash advance out, it's daily interest. So you borrow $20 out today, you pay back tomorrow, you're paying a day's worth of interest. Now, the interesting piece about cash transactions on credit card as well is this, and again, this is in your term and conditions that we don't read, is bank often use what's called sheltering. So what that is typical interest rate for retail transaction is 19.99 currently. That's your standard credit card. Often the cash transaction interest rate is 21.99, so a little bit higher. And in most banks, when you read that term and disclosure, there's usually a line in there that says something in the lines of, we reserve the right to apply your payment to the lowest interest rate transactions. So what that means is if you have retail transactions at 19.99 and you have cash transactions at 21.99, all your payments are going to the retail purchases first, because they're charging you higher interest on the cash portion. So again, if you're using a credit card for both cash and retail, you end up paying even more interest because the higher interest charges are actually being sheltered by the lower interest rate. So if you're going to use cash on a credit card, then that's the only thing you should use it for, and then use another card for retail. But again, because interest rate on cash transactions tends to be higher on credit, it's typically just a bad idea to use credit cards for cash advances, period. Without a good credit history, your bank may charge you a higher interest rate on a personal loan. Your bank may refuse to give you a loan. You might not be able to get a lease on an apartment, A and B, or all of the above. Some guesses on this one. Yeah, everyone's got that right away. So all of the above. So credit is used for a lot of things. Yes, loans, getting an apartment are definitely, the ones that come to mind very quickly. But it can also impact certain employments, certain jobs that without good credit, or if you have negative credit information on your credit file, can impact your job. It can impact certain security clearances. It can impact certain positions. So ignoring credit is never a good thing. And I know sometimes we get misinformation about credit, and we're going to talk about that this evening, of what is true information versus what are some of the myths we hear about. But credit is used for a lot of things. So it is always important to deal with it. Nothing ever disappears. So that's one of the myths, that people think that certain things disappear over time, but that's not true. Nothing disappears. So it is important to deal with it, find a solution to then maintain your credit. I mean, things happen. That's life. Absolutely. We get a bump in the road, but if we fixed it, then it comes back and we rebuild that credit. Just ignoring it is never the answer. So how to stay out of trouble? Well, again, if you use a credit card, you pay it in full every month when you get the bill, it doesn't cost you anything. So best way to use a credit card, that's how it's meant to be used. Again, nowadays, there's a lot of cards with, points and extra benefits like that. So again, if you use your credit card, you pay it in full and you're getting points, well, now you're getting something for free on top of it. Now, a lot of time, one of the justification is, well, I don't pay it in full, but I get points, so I get free stuff. Problem is, now that you're not paying in full, you're paying interest. So now you're paying for your points. You're not getting free stuff anymore because you're actually now paying for it. We have a question. Go ahead. Oh,
sorry. Hi, it's actually a comment.
Sure.
With respect to the previous slide when you were talking about the implications of, yes, that one.
Okay.
I am on a committee for a particular professional association. And when new members apply, they have to answer a number of questions about their what's called good character. And one of the good character questions is about whether they've ever declared bankruptcy or done something called a consumer proposal, which speaks to having financial problems and challenges. And I just thought I'd make a note that if someone has declared bankruptcy or has this consumer proposal thing, whereby these insolvency trustees are kind of supervising them as they pay off consolidated debt, that can prevent them from joining this particular professional association.
Yep.
And until they satisfy the committee that I'm on, that they are working to resolve their financial problems and are therefore, have what's considered quotes good character, they can't join the association. So I just thought I'd mention that there could be like implications for people who may be in a certain kind of profession where, amongst other things, they have to demonstrate that, their financial situation is stable.
Yeah, no, and that's a very good point. There's a lot of committees and boards that if you're in the process that you're not, able to join or be part of those. So credit is used in so many aspects of our world now that's why it's so important to have that understanding and knowing the impact. I'm a certified bankruptcy counselor as well. So I used to do that in the past. And I can tell you that from my experience in that world, no one ever plans to go bankrupt. But life happens. And there are times where it's the only option, but there is an impact for a period of time, absolutely. And we're going to talk more about proposals and bankruptcy as we go along. So, but very good point. So yes, it can impact things in many different ways. So again, we're talking about, using credit. So like I said, when we paid in full doesn't cost us. If we're getting points, that's great. We're getting a little extra as well. But again, as long as we're not paying interest, then that makes it worthwhile. Minimum payment is never a plan, and I'll show you an example of why minimum payment is not a plan. We talk about if you're carrying a balance, getting a low rate card. Again, those products are not as available as they used to be. Typically, most low rate card nowadays there's two types. One is you pay an annual fee. So in other words, you're paying to get your low rate card, which again, we talked a lot about the emotional and mental aspect of spending and finances in our first presentation. This is part of it. So now if I pay an annual fee for this credit card and I get a low rate, a lot of people, that's justification to say, well, it's okay if I carry a balance because I have a low rate. But low rate is a relative term. It's not 19.9, it's 11.9 or 8.9. So you're still paying something. So we need to be careful. And then the other type of low rate card typically is where you get this congratulations, we're giving you a low rate card because you're such a great customer. Because yes, you have a credit product with, whatever bank, and you never pay interest, you always pay in full. So now they offer you a lower rate and probably will offer you an increase in line of credit to try to encourage you to spend more, to maybe get to the point where now you're not paying in full. So there's reasons behind their generous offers. Now, transferring to a line of credit can absolutely be a good method to save ourselves some interest. Typically, lines of credit have a lower interest rate. So right now, unsecured line of credit, you're looking anywhere from, I'll say 7 to 11% for most. Now, some are higher than that or possibly lower. As a CAF member through Bank of Montreal right now, you do get a better rate than that as well. So, which is a great opportunity. Now, the only thing is if we pay off our credit cards with our line of credit to save ourselves interest, that's a good thing, but that also means we need to put the credit card away, because if we rack that credit card back up, well, now we're no farther ahead, which is unfortunately something that tends to happen in certain circumstances. So we do need to be careful with that as well. And last but not least, again, always paying a couple of days before the due date, just to, again, ensure that they receive the payment in time. So if you use these basic rules when it comes to credit, of the goal is to pay in full every time, it doesn't cost you anything. And again, making as large payment as possible will help you reduce interest costs when it happens. Now, there's certainly times where expenses can come along the way where we don't have the money to do a home repair, car repair, emergency. There's always something that comes up in life. So that's where certainly credit can be a very useful tool to help us with that. But this is also, when we go back to having a good budget, will also really help us with this. So if we look at a $3,000 purchase, and on this example, we use an annual rate of 18%. So if we look at minimum payment for most banks anywhere between 2 to 3%. So here we did 2.5%. So to pay off a $3,000 purchase, doing only 2.5% a month, so minimum payment, would take 263 months to pay it off, and cost $4,100 in interest. So more than the original purchase. So that is an expensive purchase. Now, if we have a good budget, we know what kind of surplus we have on a regular basis, same purchase, and we say, I'm going to do $100 a month. At $100 a month, it would take 41 months and cost an extra $1,000 in interest. Now, $1,000 is still a lot, but it's a lot less than 4,100. And again, if we have a good budget, now we have the opportunity to look at our spending because we know exactly where our money is going, and then we can make personal decisions. Okay, I'm going to cut out my Timmies for now because I want to pay this off faster, and I'm going to do 150 a month, and I can pay it off in about 23 months, and it's going to cost me only an extra $600 in interest. You know what? To me, that's worth it. That's what I'm going to do. So it's the power of having that good budget. And when it comes to this kind of purchases, again, today, thanks to the good old internet and Google or whichever browser you want to use, there's a ton of tools available to us to figure this out before we make the purchase. So you go in, just Google, credit card payoff calculator. There'll be dozens of them that come up. Find one that you like. So you put your purchase amount, interest rate on your credit card, and you start playing with monthly payments to see what does it mean. And then you compare it to your budget. How much can I actually pay? So you know in advance how much more it's going to cost you. So now you're making an educated decision. There's times where we don't really have a choice. That's where credit's coming into play. But at least we know all the details behind it. We know exactly that, well, this $3,000 necessity is going to cost me $4 in the end, $100 a month, but I'm comfortable with that, and it's a need. Okay, well, at least now I know. You go in knowing in advance. So that I always suggest. And if you're looking at even larger purchases and such, give us a call. We can help you with that. Kind of figure it out. Are there a better option? If you've got good credit, you don't have a line of credit, maybe apply for one of those, and now you can get it at 6 or 7% instead of 19.99. So, and those are the type of things that sometimes we don't always think about because we're not in that world, but we are, and this is what we do. So you give us a call and say, hey, I'm looking to do a large purchase. I'm kind of looking at options. What's the best bet? And we'll look at every option possible that we think might work for you. So we're happy to do that. So tips for managing debt. We talk about shopping around, comparing interest rate. As I said, nowadays, banks are pretty much all the same when it comes to interest rates. It's very, very similar. My recommendation is simply shop around to find a product that gives you a little something back. So everyone's got different interests. For some, it's cash back, it's travel, it's, gift certificates. You got the Canadian Tires of the world if you shop there. So again, find something that gives you something that will give you something for free. Again, the idea here is free, so that means not paying interest and paying that credit card in full every time you use it. But it's whatever works for you as far as that little extra. Nowadays, there's really a points program for everything. A lot of points program, though, they want to charge you an annual fee. So I don't think there's a single credit card program out there that I think is worth paying a fee for. So the difference is I pay a fee, let's say $50 a year, which is the average fee for most cards. So I get 1 point for every dollar. Or most banks have the same program where I'll pay $0 a year and I get half a point for every dollar spent. Well, that half a point is free. So I'd rather have half a point for every dollar spent because it doesn't cost me anything than get a point because the first 50 I'm paying for anyway. Right. So again, it's just looking, and everyone's got their own view on that, but I like free. And to me, free needs to be free. Keep it within your budget, only borrow what you can afford to pay. Again, comes back to your budget, right? Your budget dictates that. So we just talked about what minimum payment can look like on larger purchases. So that's very similar when you figure out, how much credit's available to you. So what I usually suggest is whatever line of credit your institution gave you, you got to figure out if this card was maxed out, what would be the minimum payment? And according to your budget, can you afford at a minimum double that amount? So if you can't afford double that amount at a minimum, that is probably too high of a line of credit where it's dangerous to get into trouble. Again, it's never done purposely, but it does tend to happen. So again, your budget is your guide to know how much credit is, safe to have, or for some people, having credit is a tendency to shop more or spend more. So again, it comes down to knowing ourselves that if credit is a temptation, then keep those lines of credit low to avoid that temptation. Again, if you're carrying a balance, doing extra payments is just a way to save yourself more on interest and paying those balance down as quickly as possible. Because again, the quicker we pay off those balances, the more money we save. Quick one on student loans. So student loans, in my experience, again, a lot of people have these. It's not about age, it's just about school loans. There are a lot of different programs available to assist when it comes to student loans. Big one is what they call the Repayment Assistance Program, or the RAP program for short, where through that program, they can put payments on hold, where you don't have to make monthly payments, and it also keeps your loan in good standing. The biggest problem with student loans is they're very nice about them. And if you don't pay them, you can go months and years without paying them, where they don't really harass you a whole lot. But then eventually they will, and then things get bad. And then because the loan's fallen behind, it starts limiting the option. So like most debt, student loans should not be ignored. And there are programs out there that can help as far as giving you time for better income and such, if you're not able to repay at the time and so on. So always important to know about this. Getting a copy of your credit report is a good way to check for identity theft. The only way to know if your report is accurate, free of charge if you request a report to be sent by mail, or all of the above. Some guesses on this one. You're correct, all of the above. So absolutely, checking our credit file is a good thing, just to know, what's on there. Mistakes happen all the time, especially when we look at people with similar names, juniors and seniors and things like that. It is very common to see mixed files. So it's making sure the information that is on there is accurate as far as what's open, what credits under your name. Again, to get things corrected if that's the case. Nice thing is, in today's world, there's easier ways than this to get a copy of your credit files. So like anything else, now you can do it online for free. So in Canada, there's two credit bureaus. So there's Equifax Canada, which is one of them. The other one is TransUnion Canada. So we only have two here. A lot of times we hear things from the US side, which again, they have 4 major ones there now, but here we only have those two. So you can sign up for creditkarma.ca, and I will put it in the chat for you. So Credit Karma gives you access to your TransUnion file. It is absolutely free. The reason it's free is we see advertisement for credit products. We see advertisement everywhere in this day and age, so not a big deal. They send about an email a week, and you can play with your options there. But that will give you access to your credit file anytime you want to look at it. Gives you a score as well, which is the TransUnion score. If there's credit applications done on your file, you get a notification. So there's some added safety features, and they've done a really good job at laying it out in a way that people can pretty much understand it. Because when you get a credit file from TransUnion or from Equifax, when you're not used to it, most people can't read it. It's a little bit tricky, I fully admit. And the other website to get a copy of your Equifax file is borrowwell.com. So again, I've had these sites. I've been signed up with both of these for years. I vetted them through both TransUnion and Equifax back in the day. They're absolutely legit. So it's a good way to get access to your credit file anytime you want it. Once you're signed up and you have it. So makes it even easier. So I'm a big fan of those two. They just make things a lot easier. If you've applied for several credit cards or other forms of credit within a short period of time, this could have a negative impact on your credit score. True or false? Yeah. I think that one's an easy one. And one of the main reasons is because it's been in the media so much for a long time, this whole applying for credit impacting your credit. And that's absolutely true. And the reasoning behind it is, in the credit world, if someone's applying for a lot of credit, especially in a short period of time, it brings the question why. Why are you looking for so much credit? Because that makes you look risky at that point. And this really became a bit of a challenge about 15, 20 years ago, where we had some new players in the Canadian market that were big on promotional marketing and offering free items just to apply for a credit card. And people loved it, absolutely. They would apply to get the free gifts, and we still see it today. There's just almost every store we walk into, you get offered a credit card product and free box of cookies or a free knife or you name it, right? And people say yes because they want the free gift. The problem is every time that's a credit hit on your file. So that can become a problem. So there's a very easy way to manage this. And what I tell people is simple. Apply for what you want, not what you're being offered. So if you want a credit product, you apply for it, they'll do a credit check, it will impact your score, you lose 3 points automatically. They come back in about 4 months, 3 points is not a big deal, but you want the product. If someone's offering you a product, I don't care what the gift is, if you don't really want the product, then just say no. It's not worth it because now you're starting to impact your credit for something in the end you really don't want. So whatever the gift is, it's just not worth it to you. Okay. Which of the following does not affect your credit score? So your payment history, whether you've ever missed debt payment, any collection of bankruptcy, your history of repaying informal loans from family or friends, any outstanding debt you have, or your account history. So I think that one's an easy one. That's correct. So informal loans, family or friends. Everything else is what you find on a credit file. The type of credit you have, if you've ever missed payments, bankruptcies and proposal, legal actions, that is everything that shows onto your credit file. So other types of loans. Credit cards are the most common ones. They're probably the riskiest tool out there, which is also why a credit card is the tool that will build your credit the quickest. Because it's a dangerous tool, it's an open line for individuals to use as they want. Other common ones, mortgages, car loans, lines of credit, even overdraft is considered a type of credit, payday loans and personal loans. So they all come with their own thing. When looking to build credit or rebuild credit, whatever the case is, the credit card is always the best product to use. Again, because one, a credit card really does not have to cost you money. If you use it, you pay it in full, it doesn't cost you anything. And because it's considered a high risk product, it also rebuilds credit the fastest. A lot of times, especially if there's been previous, credit issues, a lot of banks will say, well, get a car loan or get a loan of some sort. Problem is those will help rebuild or build credit, but you're guaranteed to pay interest. On a loan, there's no options there. And it doesn't rebuild credit as quickly as a credit card product does. So, and again, a car loan, because they're secured, most lenders look at those very differently. It's like, well, that's a secured loan, so it's different. But it's always, how do you pay a credit card? And that's really the important one to really maintain and fix credit, is always the best tool to use. So when we look at the various types of loans, they all come at a cost. The worst type of loan out there that is somehow legal is payday loans. And the only people that can afford payday loans are basically the people that don't use them, because they are extremely expensive. So this shows you at a glance, someone borrowing $300 for 14 days. So if we look at the average interest rate on a line of credit, so that would cost you about $5.81. Through overdraft, which tends to be a slightly higher interest rate, you're looking at about $7. Cash advance on a credit card, again, we're talking 21.99 annually. So broken down over 14 days would cost you about $7.42. And then a payday loan, $63. So again, payday loans are never good options. Unfortunately, these types of loan are typically targeted to people with bad credit. So there's a reason behind it. Again, being part of the CAF community, you do have other options. So again, when these types of scenario, emergency funds, for whatever the reason is, give us a call. That's what we're here for. Again, we work through Support Our Troops. There are different loan programs available. And if we can make something like that work for you instead, always better than going to any type of payday loan. So again, we're a resource for all of the CAF community. The key is to give us a call and ask the questions, and we'll absolutely see what we can do for you. So recognizing danger signs when it comes to credit. So again, credit is a product that was created or built for convenience, not having to carry cash. Again, the idea is you use it, the bill comes in, you pay it in full. So when we start using credit or cash advances to help pay for daily expenses because there's a cash shortage, that's never a good sign. And it's unfortunately, it's human nature, right? When there's not enough cash and we have credit available, it is normal to go the credit route. Problem is that's a very short-term fix, because then over time, the credit balances continue to grow and grow. And what happens in most cases when it's an issue of not having enough cash flow coming in, then eventually the credit card gets maxed out. So now there's still not enough cash flow. Now you own the credit card, so you can't make that payment either. And then things really starts to spiral from there. So when there's a cash flow issue, if it's a very specific item where, all right, it's just something happened for the month, that's one thing. But if it's going to be ongoing, compensating with credit tends to be a dangerous game, because unless something actually is going to happen to fix the issue, it can really make things that much worse. Start missing payments or due dates is always an indicator. If you're near the credit limit on most of your cards. So media has been really big, for years, talking about how applying for credit hurts our credit score. But this is when they don't talk about it. So if your credit cards are all close up to your available credit, so they're close to max out, that will absolutely impact your credit score as well. Not, you're not missing payments or anything like that, but because that bounces up there and it's not really going anywhere, in the credit world, that's considered a risk at that point. Because now you're demonstrating that you've lost the ability to pay down. And the ability to pay down is important in the credit world. So anytime that you use a credit product and you exceed 60% of usage and that balance stays there for more than 3 months, it starts to impact your credit score. Now your credit score starts to go down because in the credit world, it's demonstrating that inability to pay down all of a sudden, which is again, something that's important to know when we're trying to rebuild credit. Borrowing from one card to pay another or doing a lot of balance transfers can be an indication of potential financial difficulty. Now, balance transfer for introductory offers can be a way to save money, absolutely, but it takes work and you need to understand exactly how the offer works to make sure that you work with it properly, so you don't end up in a sheltering where, all right, I got 1% for 6 months on my balance transfer, but now that's over and I've got retail purchases. So now my cash transaction are being sheltered by my retail transactions, and now I'm paying 21% on all those. So again, it's really making sure to understand how it works before we use some of these deals. So take control of debt. So if you have debt, you've got various things, credit cards or loans. Financially, if you have savings, it makes sense to use those savings to try to pay off or pay down as much as possible on those debt. And part of the reason is this, because financially, we all know that in this day and age, unfortunately, when it comes to investments and savings, it doesn't tend to gain us a whole lot in most cases, especially if funds are just sitting in a savings account or even just a regular tax-free savings account. You're lucky to get 1.5% per year. But in the meantime, you're paying 19.99 on your credit card. So financially, it doesn't make sense. Now, I understand there's also an emotional piece to it that for a lot of people, if we have some of that money stashed away, for emergency or whatever, it gives us a level of comfort. But if your credit cards are in good status, you've never missed payment, everything's good, you use that money to pay down. So now you've created some room. Again, now we're not using the credit card, we're just trying to pay it down. If an emergency comes up, worst case scenario, we'll have to reuse that credit. But if nothing actually happens, well, now you're paying down. Once you've paid off all your credit, now you've got an opportunity to start building savings again. And those savings, whatever interest or return you're getting on those, you are actually getting. Because even if you're getting a 5% or 6% return on one side, which in today's world is considered pretty good, if you're paying $19.99 on the other side, you're still losing money because you're not compensating for that. So things to think about. Again, switching for less expensive card, not as much of an option, but definitely looking at, lines of credit can be an option, consolidation loan type, and those are definitely ways to save you some money if everything's on high interest rate credit. Calling creditors can negotiate. Most creditors nowadays don't really negotiate a whole lot. Never hurts to ask, absolutely, but most of them don't. So we got to set the right expectation here. Some will help, but not until you've fallen behind 3 or 4 months in payments. So when you try to be proactive, let's say you're running into a financial situation, you call them for help, they're not helpful. Now you've fallen behind 3 months and now they're willing to start helping. It's very unfortunate, but it is how it tends to work in most cases. Well, like I said, never hurts to ask. If you have a tendency to forget doing bill payment, so again, automatic payments can be done through your bank. Schedule things in advance so you don't forget. If your credit cards are a temptation as far as making purchases and such, again, just leave them at home. Don't bring them with you. Credits for emergency, perfect. That means you don't need to carry it with you. You just put them in a safe place, make sure they're secured, and leave them there. Often suggest you avoid buy now, pay later offers. And the reason for this is, again, for most people, we buy now. So 18 months later, we need to pay. Problem is we haven't put the money aside during that 18 months. So now we start making monthly payments. These are considered retail cards, and the typical interest rate on a retail card starts at 26.99. So even higher than a standard credit card. So again, that can make a purchase very, very expensive. And a lot of places charge administration fees as well. So depending on the duration of the buy now, pay later, can be, $25, $50, $80. So again, we got to make sure to see what makes sense. And we have to be honest with ourselves. So if you're good at budgeting, you're good at putting money aside, you buy now, you put it on a no interest plan for 18 months, you put the money aside, or you start making payments right away regardless. 18 months later, paid in full, that's okay. But again, we need to be honest with ourselves. Most people are not good at that. So we need to admit to that piece. So we just need to be careful. And then the whole consolidation loans, again, paying off a bunch of debts at a lower interest rate is a product that used to be very popular. Nowadays, getting consolidation loans from banks is a lot harder because of some of the regulation and changes that have been done over the years. So it gets very, very difficult to use a consolidation loan. Now, for homeowners, if you have equity into your home, that is often an opportunity if there's a lot of debt out there to look at remortgaging, paying off all your debt. Mortgage rates right now are still very, very low, so certainly can save you some money. Probably the biggest thing that, or roadblock, I would say, when I make that suggestion for people sometimes is everyone's always concerned about, the penalties. Oh, it's going to cost me $5,000 in penalties for redoing my mortgage early. And I understand that. But then if we start doing the calculation on your debt and how you're paying that down and those interest rate, a lot of time those penalties get paid back pretty quickly. And again, if it's something you're considering, trying to figure out, those are things we can help you with to say, well, okay, what are the penalties? What's it going to cost you? And then we can analyze your debt load to see, well, based on how you're paying right now, or just simply using those payoff tools, will show you how quickly you're making that up. So definitely looking at the option of utilizing your own equity sometimes is a good way to save yourself a lot of money. So when it comes to financial issues, again, to most people, there's 4 options. First one is for them to deal it by themselves. Next option after that, there's financial counseling for just general public. where again, credit counselors there have certain programs available to them to help people reduce the debt load, pay less interest and such. When it comes to public financial counseling, the key is always nonprofit organizations, because there are for-profit organizations, and those unfortunately give the whole industry a very bad name. So always make sure that you go for nonprofit. Next step after that, we were talking a little bit earlier about consumer proposal and bankruptcies. Again, those are legal ways to help you deal with debt. It is done through a licensed insolvency trustee. And again, it's a very regulated industry. The rules are very straightforward. There's not a lot of leeway. Now, some are better than others. Like every industry, some people are better at their jobs than others. So it's always trying to find a good, reputable trustee to work with. And again, for all of you being members of CAF, is you have us, you have SISIP. So basically, we don't do proposals in bankruptcy, but we basically are here to serve you, to help you figure out ways when it comes to money issues. So we're financial counselors. You know, we look at ways, we have support or true programs that can help, and we will look at every possible option, you know, from just giving you a little bit of guidance on how to get out of debt, you know, through your own methods, through looking at loan programs that might be helpful, to some circumstances suggesting a consumer proposal or bankruptcy, to tell you that's the only way to fix this. It does happen that it's unfortunately the only option, but consumer proposal and bankruptcy is not the end of the world by any means. You know, life happens. Sometimes it's just the best way to get back on our feet to fix things. Again, in my 7 years as a bankruptcy counselor, I've never seen anyone that, you know, planned this. Most common scenarios for proposals and bankruptcies, you know, unexpected loss of employment, illness, marital breakdown are the three major reasons for consumer proposal and bankruptcies, and no one plans for those. You know, it's just, that's life that happens, and these are ways to help deal with the financial issue to get people back on their feet. And it's absolutely fixable. You know, people often misunderstand the whole 7-year thing. So with bankruptcy, oh, I can't get credit for 7 years. Well, that's not true. Okay. So to give you an example, a first-time bankruptcy for an individual, it's all about income and assets. So assuming you don't fall in this, what they call a surplus situation as far as income goes, a first-time bankruptcy is a 9-month process. You're considered bankrupt for 9 months. Typical cost, $225 a month for the 9 months. You need to attend 2 credit counseling sessions and show proof of income for the first 7 months. As long as you follow those rules, after month 9, you get what they call your automatic discharge. So you're no longer considered bankrupt. So you're not bankrupt for 7 years, you're bankrupt for 9 months. After the 9 months, now you can start fixing your credit, assuming your budget can support it. Your bankruptcy will show on your credit file for 7 years, yes, but it doesn't mean you can't get credit. There's ways and products out there to help people rebuild credit. If you are in a surplus income situation, first-time bankruptcy, then it's 21 months. So just under 2 years, it's a little bit longer, and the cost will depend on how much surplus you have in your income. And again, it's a very straightforward calculation. So first-time bankruptcy is really a chance for people that something happened, you know, that they just can't get out of it, and it's a legal way to do it, and it's fairly simple. Now, second-time bankruptcy is different. Second-time bankruptcy is minimum 2 years, up to 36 months, so up to 3 years. And then third-time bankruptcy is 3 years, and there's no such thing as a fourth bankruptcy. In Canada, you can only go bankrupt 3 times. After the third time, you'll never get credit again, or if you do, you won't be able to go bankrupt again. Legally, you're not allowed. And then the consumer proposal is, you know, similar to the bankruptcy. It's really a step below. And what they do on a consumer proposal is the trustee offers settlement amounts to your creditors. So based on your income, living expenses, they'll figure out what seems to be a fair amount to pay back, which in most cases, they're able to reduce between 60 to 50% of the debt load. Then they'll put that total amount on up to a 5-year repayment plan. So there's pros and cons for both. It's a very individual thing. It depends on the individual's personal situation, you know, things that might come up within the next 12 months or so. But again, very regulated, and sometimes it's just the best way to get out of trouble. So we talked already about Equifax and TransUnion, borrowwell.com and Credit Karma. So again, a great way to get access to your credit file when it comes to that. So I will now open it to questions. I will put my contact information on the screen. So again, if you ever have questions or anything, feel free to call me or anything like that. I'm more than happy to do so. And before I open the floor for questions, I'm just going to get and stop the recording. So thank you again for attending.